Fed decision, what does it mean? So yesterday, FOMC meeting minutes, was released. Powell came out and read off the release and answered some questions. So what were we expecting? The last FOMC meeting minutes, they talked about being significantly more aggressive, right? More hawkish, right? Hawkish means more aggressive. Dovish, passive, okay? When would you be dovish? When would you be hawkish? You'd be more dovish when you're trying to stimulate the economy by lowering rates and making money cheaper. And you'd be more hawkish when you are trying to slow down an economy or slow down inflation, right? So these are some things that you take into consideration. Now, interest rates were at about 2.5% pre-COVID. COVID happened. Everyone went out of work. The world shut down. Economies came to a grinding halt. Government jumped in, gave stimulus, got people spending. That helps the economy, but you need big size purchases. You need big stuff to go. You need to keep people working. You need long-term builds and projects. What takes long-term builds and projects? Expensive things. How do people afford expensive things? Well, most Americans didn't have, prior to COVID, more than $400 in cash on hand to cover an emergency expense. So how do you make things more affordable? Well, if people have to take out loans because they're big projects that require time and lots of people to make, they're expensive, so people have to take out loans. Well, loans have interest. So what do? You make it more accessible for people to borrow money. I'm not going to get into the bank side of it. I'm talking about just from an economic standpoint, right? So interest rates went from 2.5% down to basically 0%. It was a little bit higher, but we'll call it 0% for the sake of this whiteboard. So now mortgage rates went from 4% down to 2.5%. Right? Because treasuries were dropping, people were putting monies into bonds. I mean, everybody's like, oh my God, the market, the economy's fucked. Let's put our money into bonds. Bond rates were high. Treasuries were low. All of this happens. The stock market goes up. Everything's going well. And then all of a sudden, we start seeing a little something kick in. Now, we've already done previous videos, and we can put links to them down below about supply chains and about the shutdowns in China at the beginning of COVID and the kink effect and the slinky effect and how that all took place. I could do all that. But that's many of the factors. But we started seeing inflation. And we started seeing inflation. Originally, people said, well, it's fine to have a little inflation. Why? Because there's a lot of demand. People have money, and we want them to spend it. So it's okay to have some inflation. Matter of fact, our inflation numbers are so low right now, we need to get them higher. We need them at 2%. That's our target inflation. We want it at 2%. It's below that. We need inflation. Inflation's good if you've got maximum employment and you've got GDP growth, but it's got to be sustainable. And then we started seeing some spikes. We saw a month over month of 3.5%. It's transitory, guys. It's just a short-term thing. We saw it at 4%. Hey, that's fine. We were so low that you take the 3 months at 1% and 3 months at 4%, that puts us right at target. We got to 5%. Still transitory. I think we're going to peak. Well, hey, Fed, you probably cut the rates now because we're at that point where, you should raise rates now because we're at that point now where we've kind of lifted ourselves to that target, right? We don't want to get this out of hands. Let's do that. Nah, we'll do it, but we just can't do it right now because there's just too much going on, too many people out of work, too many businesses failing. The economy, we need to get everybody back to work. All those people who lost their jobs, that 11 million people that lost their jobs when unemployment went to 20%, we need to get full employment. Then we'll worry about it. Oh shit, we're at 6%. That's okay, it's still transitory. All right, let's retire the word transitory. Hey guys, employment is probably as good as it's gonna be right now. But we really need to work on this. Okay, we'll consider raising rates next year. My man, it's November. Okay, you've been saying this for a year. What are we gonna do? Then we saw inflation at 8%. So now we see the Fed going, oh shit, we've kept interest rates at basically 0%, and we've added $3 trillion in treasuries to our balance sheet. Mortgage-backed securities, the whole 9 yards. We're just taking on more and more and more. It's like a ship taking on more and more water. You're like, it's okay, it'll float. It can take a lot of water. But, all of a sudden, you thought if one of these cargoes busts and it fills up with water, you're fine. What happens if 2 of them start filling up? And all of a sudden, because there's 2 punctures, and all of a sudden, it fills up here and starts spilling over, okay? That's what we're trying to avoid right now. That balance sheet is getting a little too thick. So the Fed is having to overreact in a way. Now, I honestly believe the Fed knows monetary policy better than I am, so I'm not saying the Fed is doing is right or wrong. I'm saying from the way I'm looking at it from a Monday morning quarterback, outsider looking in, it seems like they took a little long to start raising these rates. And the reason that it's important to raise rates is because that is demand. Inflation happens and deflation happens when there is an imbalance in supply and demand. Demand happens when people can afford things or want things and they can afford it. Supply is how many of those things are available. Let's talk about housing. Housing prices continue to go up, but interest rates were low, so people could take out those loans. But once you raise the interest rate, it's no longer as cheap to buy a house and finance for a house. So therefore, the demand for housing goes down. And if the supply is the same, hopefully, theoretically, you would think that the housing prices would go down, right? So that's supposed to happen along the board. So they are trying to raise rates at a higher clip because they took too long. And so in this case, inflation has started to get ahead of them. It's like getting out of reach. So we're having to be more aggressive. And so what they're doing is they're trying to shore up demand, but they have no ability to control supply. And this is the big problem here, and that is China is in lockdown again. I showed you guys the map this morning during the morning call of all of the thousands and thousands and thousands of ships that are sitting off the coast of China doing nothing, waiting for reopening and for manufacturing to happen to load up and send over here. And instead of a constant back and forth, it's all built up here with nothing over here in the United States. And so what happens is you run into that kink. Remember that slinky effect we talk about? Here we are. Now, when all of the demand, it pulls up all the stuff on the inventory, there's nothing to refill it. So now there is a inflation surge again because there's a supply chain crunch. Then when all these ships get filled, instead of having that constant back and forth, they're all going to come here and we're going to have that Long Beach port shit again where they're all sitting here unable to load. And that's that backlog. So they are aware that that's going to happen, but they can't wait any longer. That brings us to last report. And the last report was significantly more hawkish. Originally, they had priced in 25 basis point increases for 9 months. But then inflation numbers kept going up. The inflation kept going up, even though everybody thought it was going to peak. So then they started getting more hawkish. Bullard coming out and saying, hey, we need to have a 100-point basis at some point. 75 for sure. Maybe multiple throughout the year. Everybody's like, Bullard's a fucking hawk. He's always a hawk. But then Maynard, who is the most dovish, also came out and said, yeah, we're going to need to tighten up. So then people were like, wait, if the person on this end of the spectrum is starting to sound like the person on this end of the spectrum just moved a little bit. We're more into that hawkish territory for sure. So now the market starts pricing in 50 basis point increases at least once. And after the last report, the Fed said, hey, listen, we are going to raise interest rates every single FOMC meeting from here until next year. So that means money's going to become more expensive. Money becomes more expensive, especially in large. You have less big-time purchases, meaning you have a slowdown in GDP and economic growth. You also have less money for businesses to expand and have cash on hand, meaning corporations are probably going to cut their guidance. They're going to lay off people. They're going to have less money in R&D, less buybacks, potentially, which means less growth, which means investors start dumping money from these equities that they've made a lot of money in. If they're dumping money, they got to put their money somewhere. And that's why we're seeing treasuries and bonds go nuts. We're seeing commodities go nuts and other things. Also on the supply side, Russia, Ukraine, oil. Everyone needs oil. I don't care how green you are. Well, I drive an electric vehicle. Do you know how much oil it took to power the facility that built your car? Do you know how much oil is in the plastic and the rubber on your car? The plastic bag you got from the store? Batteries? Your television? Your chair? Your desk? Your computer? How much oil it took to deliver that? It's oil doesn't go away. And with reopening and traveling and energy crisis going on, oil is even in more in need. And you've got Russia and their big export of oil to the EU, and now the talk of a shutoff there or a cutoff there. So there's other problems. That's going to drive gas prices up and the price of other commodities up. That is back on that supply side. They can't control that. So they've gone to basically said, we're going to hope that inflation has peaked, but we need to do something about it. So that's when the increases start coming out. Now, last time everybody got scared and they said, wait a second, we were kind of 50-50 on a 50 basis point increase. But after the last one, we've all but guaranteed a 50 basis point increase for May, with probably the chance of 3 or 4 more, maybe even a 75 basis point increase later on. Because this is what we talked about last year. The longer they wait, the more drastic they have to make those increases. So what did we talk about earlier this week and yesterday during the morning call ahead of the FOMC? We talked about the potential, obviously potential, for them to be more dovish. Why? Because in between the April meeting and the May meeting, we got the GDP report. And what did the GDP report show? We went from a 6.9% quarterly increase last quarter to an expectation of a 1.1% increase this quarter. A pullback, but still an increase. What do we get? Negative 1.4%. What is one of the standard definitions of a recession? 2 quarters of negative GDP in a row. 50% the way there. So now everybody's saying, oh shit, what are they going to do? If they raise 50 to 75 basis points consistently the rest of the year, that's going to slow GDP down, and GDP is already negative. We might go crashing into a recession. If they don't raise it, we're going to go into stagflation, right? So it's a very fine line that we're walking right now. So I told you guys my expectation, at least for me, was that they were going to come out and sound more dovish. They weren't going to lower it, but they were going to sound more dovish as far as what they were going to do after the GDP report. So I was expecting to have a big day yesterday. Nowhere did I expect a 3% day. Obviously not, but I expected to have a good day. That's why you guys saw me play SPXL, which is 3-time leverage SPY, after Powell started talking, and that thing went 9%, which I'm really happy about. I got lucky with that, obviously, but regardless of what we thought was going to happen, because we could have been absolutely wrong, let's talk about what did happen. And that is, Powell, when he started talking, said one thing that was the reason I dumped 50% of my portfolio into leveraged SPY shares. The one thing, you guys were watching me live when he said one thing, and I said, I'm fucking going in. And he said, 50 basis point increases are on the table. That is the most dovish thing he probably could have said without people worried about crashing. Why? Because on the table means not even guaranteed. If he would have said, because they raised it by 50 yesterday, if he would have said, we're keeping an eye on it, 75 basis point is still on the table, that would have been hawkish, right? But he said 50 is on the table, 75 isn't even being talked about right now after the GDP report came out. So now investors are looking at that and saying, okay, we're going to try and curb inflation. We are going to increase, but we've already priced in 50. So, okay, maybe we've bled out what we need to. Now you might be saying to yourself, well, Stocky, that's dovish. That's good. No. That is not dovish. 50 basis point increases is not dovish. Yesterday's 50 basis point increase was the first time in 22 years that we have raised it that much at one time. 22 years since they raised it 50 basis points in a single meeting. There was nothing dovish about yesterday. But compared to last meeting and compared to sentiment, it was dovish. Still hawkish, but dovish compared. So we saw an overreaction yesterday. Oh my God, we're dovish. Let's fucking go. And I was like, all right, cool. I want to make some money. But then it kept going and going and going. And we ended up closing within the last hour and a half, the highest run as far as green day since 2020 COVID bounce. And you guys are saying, Stocky, do we hold these? I'm up 500% on SPY calls. Do I hold these calls? I told you guys, I'm not holding a single one of those SPXL shares overnight. Why? Because of what we just said. It's dovish compared to last time. It's still hawkish moving forward. If we're sitting at 0.75 now, and we have June, July, August, September, October, November, December, 7 more. Let's say we do 3.5, so that's 1.5, and we do 4.25s, that's 1, and we're at 7.5 now, so that's 2, that's 3.25 by year's end. Just throwing it out there. Even if we only do 2, that's still sitting at 3. That's 50 basis points higher than we were in 2019 before COVID. What's a basis point? Oh, sorry, 100%. So 100 basis points would be 1%. Now, they made it very clear that there are a lot of outside factors. So there's no guarantee yet, but this just gave us a quick breath. And so when you have an overbuy, an overreaction to the upside, what do you need? An overreaction to the downside. I'm not saying that we shouldn't have it go down, but there's no reason for a negative 3.5% day today after a positive 3.5% day yesterday. That's just balanced as all things should be, right? Which tells me that I would expect us to get some of this back today or tomorrow so that yesterday's gain of 3.5% over the course of a week looks like a 1% gain. So I wouldn't be surprised to see like a 1.5% swing from bottom today till either end of day today or sometime tomorrow. I'm guessing, but I wouldn't be surprised to see that. Where does that leave us? That leaves us at the point of unknowns. Investors don't like unknowns. So I do still expect downside pressure because we still have, Fed is still hawkish and inflation report is coming out, is going up. Now, some people are saying, yeah, but we've peaked, right? We've peaked. Sure, we've peaked. We may have peaked if shit gets back to normal. but shit ain't getting back to normal. Those big inflation reports that came out in the beginning that were up like 5, 6, 7%, most people didn't pay attention to them and called them transitory because it was like used vehicles, right? Made up like 60% of the increase. Everybody's like, that's just a supply chain issue. That'll find out. We're fine. And then we were right. As supply chains started getting back under normalcy, used vehicles prices started kind of coming down, but inflation wasn't. So you're saying to yourself, wait a second, I thought if that made up 60% and that's down 20%, we should be down. Why are we still going up? All of a sudden, Russia, Ukraine, gas, natural gas, energy, crisis, food, household goods, medicine. Guess what else has been skyrocketing? Anybody here booked a flight recently? Travel. And right now, China lockdowns, Russia, Ukraine, resignations, tighter money layoffs, and labor participation are those things that affect supply that the Fed has no control over. And you might be saying, but they keep saying unemployment's at 2% and the labor force participation is almost maxed out. They take two things into consideration that or don't put into consideration to get those numbers. Number one, unemployment only accounts for actively looking for work. Unemployment does not equal labor participation. Early retirements, resignations, people walking away, people quitting one profession and going into another, people staying home and starting their own businesses that may fail, people working multiple jobs. Also, we've ticked up from 11.3 job openings to 11.5 million job openings. Why are we seeing 200,000 more job openings instead of less job openings? Also, in April, we got the report that 4.5 million people resigned. That makes 10 months in a row of 4+ million people resigning. It has not slowed down. As a matter of fact, last month, 4.5 million. It's not even slowing down. Well, Stocky, those people are resigning and getting jobs elsewhere. No. And there's about to be a hell of a lot more people in the workforce because these businesses that were expanding so much with all that cheap free money during the 0% interest, or the low interest rate time are laying off. We've seen Zoom. We've seen Robinhood. We saw that company from the other day, 75% of their workforce cut. We're seeing so many businesses cutting workforce. And you've got a company like Airbnb. What did they announce the day before their earnings? They're going to have 100% of their employees work from home. That sounds great, Stocky. Nobody's losing their job. Everybody's going to be happier. Janitors, electricians, on-site IT, cleaners. Those people there's no need for them. None of this is FUD. I'm not trying to warn you guys of anything, but I'm trying to tell you guys of what led up to yesterday, what we heard, what was digested, what's actually happened, and the challenges that are facing us ahead. Now, tomorrow, China could come out and say, you know what? Enough of this COVID zero tolerance bullshit. We're fine. Let's get everything hopping and running again. Get those ships loaded, send them. Russia goes in and says, you know what? We are wrong for this. You keep Ukraine. We go back home and everybody fun. COVID disappears. Elon Musk, Jeff Bezos, and Bill Gates and Zuckerberg get together and say, you know what we're going to do? We're going to each take 10% of our net worth. We're going to build a sustainable food thing and international clean energy, whatever. Everybody sings Kumbaya. Some of you guys finally get laid. But all those things I just said are 100% not going to happen. So while there's always a chance, it's most likely not. So this is what we're faced with. And that is why we had an overreaction yesterday and overreaction today. In my opinion, as far as moving forward, I still think we're bearish overall on the yearly. That could change at any time. And it doesn't mean every day is going to be red, every week's going to be red. But I think there's so many unknowns right now that I have a hard time believing we're going to get back to 480 by the end of this year. I think we're more likely to see 380 before 480. I hope I'm wrong because I'm a long-term investor and I'm buying dips, but I don't want to be putting all my money on the way down. So we shall see what happens. Do you still think we bounce today? I think we get some of the overreaction back today. I just don't know. I would be more inclined to believe that we finished the day at 2% down rather than 3.5% down, but that's just me. All right. Did that help anybody, or did everybody just feel like I wasted my time with that? Remember, I'm just one guy, my opinion. Okay. I don't want you guys thinking that that is the end all be all and that's what's going to happen. I'm just giving you my interpretation of everything based on my experience and my stupid, weird ADHD brain.